to the Roundup, covering what's important to accountants and advisors across the month of July. Inside this month, the raft of tax practitioner rule changes and where we're up to. We'll look at the case that explores when a gift is really a gift for tax purposes. But first up, the ATO have released their top 5 work-from-home questions for individual taxpayers. Matt, what's on the list?
I suspect the ATO's recent Q&A is timed to coincide with the fact that the income year's just finished, so that we're now thinking about preparing tax returns for our individual clients. And as we're doing that, we're starting to think about claiming deductions for these individuals for their home office running expenses. Now, there are 2 approaches you can use when it comes to individuals looking to claim deductions for these expenses. The first is the actual method. The other way is what the ATO now calls the revised fixed rate method. Because the record keeping requirements are actually quite onerous, especially in relation to apportioning deductions when using the actual method, I suspect many clients are just going to naturally gravitate towards the revised fixed rate method, where the record keeping requirements are a bit simplified, they're a bit more relaxed, but at the same time, it still gives clients the ability to claim a deduction of 67 cents per hour worked from home, subject to meeting some other basic conditions. Now, this revised fixed rate method is where most of the Q&A is targeted. And the ATO, they do make it quite clear that there is no minimum number of hours worked that you need to work from home in order to use this revised rate. So in theory, you could have someone working from home an hour each week and still be potentially eligible to use this revised rate. You just do need to be careful though, and you do need to check that the individual, they're performing substantive work duties from home. So if they're just at home occasionally checking emails, occasionally taking calls, that's probably not going to cut it. The other important thing to remember is that while this revised fixed rate, it does simplify the record keeping requirements, and it was, brought in to make our lives a bit easier, the ATO is quite keen to remind us that there are still some record-keeping requirements that need to be met. And one of those is that the client needs to keep a record, whether that be a timesheet, spreadsheet or roster, of the total number of hours that they've worked from home during the income year. In fact, the Q&A goes a bit further and suggests that you do need to keep start times and finish times each day that you've worked from home. Now, some of you might be aware that there was a transitional period where you could keep a representative sample, say a diary of covering 4 weeks of the hours you worked from home during those 4 weeks. But that transitional period's over, and that representative sample just simply no longer works when you're trying to use the revised rate. And I guess what I'm trying to say here is that if you've got clients that are looking to use this revised rate, it's just a bit more than asking them, how many hours have you worked from home during the year? There are probably some other prudent checks that you can do that you should be undertaking, and you should be making sure that your client meets the record-keeping requirements. And even though the record-keeping requirements are a bit less onerous than what the client would otherwise need to have, there are still requirements there that do need to be met.
So Matt, it's pretty common for clients who are working from home to use a mobile phone as part of that work. What are some of the things that they need to be aware of when it comes to mobile phone costs and how that interacts with some of the ATO guidelines around working from home?
That's a really good question, and the approach is going to probably depend on whether the client is using the actual method or the revised fixed rate. If you've got clients that are using the revised fixed rate, well, then that method already covers deductions for mobile phone usage and data usage costs. So your client can't then go and claim additional deductions for that, even if they take their mobile phone and they're using it at their workplace as opposed to their home. However, the revised fixed rate does not cover depreciation deductions on things like home office equipment, so things like tables, desks, computers. So even for clients that are using the revised fixed rate, they can go and claim additional depreciation deductions for those types of assets to the extent that they're using it for work. Now, the ATO, they've updated its practical compliance guide, their guidance in this area, to basically clarify that can also include additional depreciation deductions for mobile phone handsets. So even if the client is using the revised fixed rate, the ATO's updated guidance suggests that it can be possible for clients to claim depreciation deductions for mobile phone handsets that they own, to the extent that they're using it for work, of course. If your clients are using the actual method, then they can go and claim deductions for mobile phone plan and data usage costs, as well as depreciation deductions for their mobile phone handsets, any handsets that they own, again, to the extent that they use it for work. And there's an apportionment that needs to be done there. And that apportionment between work versus private use isn't necessarily the most straightforward. The ATO in its recent Q&A suggests that there's probably a couple of different ways you could go about making that apportionment. The way that they think is probably the easiest way is where the client keeps a diary, some form of record over a representative period of 4 weeks that tracks their typical mobile phone usage. So the types of calls that they're making, whether they're making private versus work calls, and how they're using their mobile phone. Are they using the internet on that phone to browse websites versus private sites, and make the apportionment that way. Now, clients aren't naturally going to be keeping track of how they use their phone, and they're certainly not likely to be keeping records of that. So it's on us to prompt our clients to do that if they need to.
Let's look at the issues impacting on tax practitioners. Lisa, there's been a lot of controversy about some of these changes that are coming through the system at the moment as they impact on tax practitioners. And it seems like a lot of the stress is caused by the speed of change. What has actually changed?
Yeah, thanks, Michael. And speed is the name of the game here. Now, there is a little bit of pressure off because of the extension of the deadline to implement the Code of Conduct changes from 1st of August. But before we get into the raft of changes impacting practitioners, let's just take a little step backwards and look at how we got here to provide some context. Now, as you remember from the media reports, a former partner of PwC utilised confidential government information about impending tax change for personal gain. This confidential information was distributed in Australia and overseas to help clients sidestep impending laws. The Senate inquiry that resulted out of this suggested somewhere in the order of $180 million per annum of tax revenue was put at risk, but also PwC earned somewhere around $2.5 million from that first tranche of advice that they provided. Now, this issue is not so much about PwC. This issue is about the deficiencies in the system exposed by this scandal. Some of those deficiencies were in the laws regulating practitioners, in the limited investigative powers of the TPB. It's also the promoter penalty laws were not strict enough. And then, of course, the information gathering powers of government agencies were not up to the task of meeting this particular scandal. And in response to the scandal, there's been a raft of changes impacting tax practitioners. We've got breach reporting that came into effect on 1st of July this year. Now, this requires tax practitioners to report their own breaches of the Code of Conduct, but also those of other tax practitioners as well. We have annual renewal from 1st of July. We have whistleblower protections also from 1st of July. We have extended powers, investigative powers of the Tax Practitioners Board. There are enhancements to the TPB register. So if you jump online now, you'll see more extensive information available there, including any actions taken against the practitioner. We also have, and importantly, extensions of ministerial powers. Now, these powers were utilised by the minister to extend the Code of Conduct. There was additions made to the Code of Conduct. Those changes, somewhat controversially, were supposed to come into play now on 1st of August, but have since been extended to 1st of July 2025 for practices with 100 employees or less, but for larger practices from 1st of January 2025. But on top of all that, from 1st of January, there's also the changes on disqualified entities. Those tax practitioners providing tax agent services cannot utilise disqualified entities, which might be an individual, it might be a company, or it might be an association. You cannot use disqualified entities from 1st of January 2024 without permission from the Tax Practitioners Board. And on top of all that, just recently released is from Treasury a consultation on the review of the tax practitioner registration process.
So how will the changes impact at a practical level?
Yeah, and there are quite a few impacts. If we just look at a few practical examples, recruitment is one of them. You'll have to make sure you check the TPB register to make sure that individual or entity is not disqualified. This also might mean police checks of individuals to make sure there's no criminal convictions. We'll look at practice policies, making sure that they do meet these reforms. The client engagement process. Are you advising clients of the right things at the right time? It also means staff training, looking at that on the supervision and staff training and making sure it is adequate for the supply of tax practitioner services. Plus also systems and support, because there will be extended record keeping requirements and you need to make sure your systems are up to that. For members of Knowledge Shop PD will cover the changes, the impending changes to the Code of Conduct, breach reporting and a series of other areas as well. That's on 12th of August. If you haven't already registered, jump online and register now. In cases this month, the Federal Court has handed down its decision on the treatment of amounts received from family and friends. Michael, how did this one play out?
Yeah, so this is the Federal Court decision in the Risenoff case. It's an appeal from a tribunal decision late last year. And basically the facts were that a couple of taxpayers had received a number of deposits into their bank accounts. And basically when the ATO reviewed, audited taxpayers' affairs, they weren't convinced that these amounts that had been deposited into these bank accounts shouldn't be taxed. And therefore basically sought to tax the taxpayers on these amounts that they'd received. Well, the taxpayers argued that these amounts were effectively either gifts or loans from family members and family friends, and so should therefore not be included in their taxable income. And this was basically the basis of the dispute between the taxpayer and the ATO. Now, the taxpayer objected to the ATO's decision. That was denied. And so the ATO had taken the firm approach, really, that these amounts should be taxable. We then ended up before the tribunal, and the tribunal wasn't there to decide whether these amounts were taxable or not. The tribunal was really there to decide whether the taxpayer could prove that the ATO's assessments were excessive. The taxpayer could not do that. And there are a number of reasons why the AAT decided that the taxpayer had not provided sufficient evidence to prove basically that the ATO's assessments were excessive. And really, as a taxpayer in a space like that, your job is quite hard because you not only need to show that the ATO's number is wrong, you need to prove what the right number is, and they simply couldn't do that. Well, this then has travelled to the Federal Court. The Federal Court basically had to look at whether the AAT decision was reasonable or not, whether the AAT had followed the correct procedure in reaching the final determination. Well, the Federal Court ended up basically finding against the taxpayer. So as things stand, the taxpayer is going to have to pay a fairly significant amount of tax on these amounts that were transferred across to them into their bank accounts from family members and friends. Now, let's just get into why might it be that these things were shown, or why the ATO decided that these things should be taxable. Well, a few reasons for that. One of the big reasons was that there was a lack of really clear evidence to explain exactly what these things were. Now, interestingly, when this matter ended up before the Federal Court, the taxpayer was referring to some specific guidance on the ATO website dealing with things like gifts and loans from family and friends, particularly from overseas, because this is an area that a lot of people are impacted by. And we've covered this guidance in the past and pointed out that the ATO says, look, if you want to kind of demonstrate that amounts you receive from family or friends are genuinely gifts or they're genuinely loans, here are the types of documents that we would typically expect to see in order to provide evidence of that. But the Federal Court pointed out that just having that documentation in place does not mean that the amounts you've received are genuinely gifts or loans. And that was the issue here. The Federal Court said, yeah, we can see that there are some documents. For example, the father of the taxpayer had kind of prepared a deed, a document to say that I've given this money as a gift. But the federal court said that that alone doesn't necessarily mean it's a gift. You still need to look at all the surrounding circumstances. And one of the things that the AAT wasn't hugely excited about, if you read through the AAT decision, was there were some real gaps in the evidence that was presented. For example, no communication at all was presented in terms of messages, emails, text messages. So we had all this money coming into the taxpayers' bank accounts with no communication at all. The AAT said, look, it's pretty unlikely that that would happen with no communication at all. So that led the AAT to maybe suspect maybe there was some documentation, it just hadn't been presented, maybe because it wouldn't have been favourable to the taxpayers' arguments. The AAT was really speculating. They didn't know one way or the other, but there were some gaps in the evidence. So really, what this case points out to us is that when we have clients who are receiving sometimes significant amounts into their bank accounts, we need to be really careful in terms of trying to figure out what those amounts represent. In this case, there was evidence of business dealings between the taxpayers and their family members overseas, the friends of family overseas. And it seemed like the taxpayer hadn't received market rates of remuneration for the work that they had done. Again, it leaves things open for, say, the ATO to say, well, this money you've received, at least some of it, possibly would represent remuneration for those business dealings. And so we need to look at all the surrounding circumstances. The other thing to remember here is that once we get before, say, the tribunal or the federal court, it really comes back to that issue of not just proving the ATO got it wrong, you need to prove what the right position is here. And that's something that the taxpayer failed to do.
What are the things that we need to be aware of in the tax system when clients receive money or funds from related parties?
Yeah, there's a few things that we want to be mindful of, particularly where clients are receiving money from overseas related parties, because that is something that draws attention. And one of the reasons for that is the way the system works is that if funds are transferred into Australia and we've got a $10,000 threshold, it gets reported to the government, basically government authorities through AUSTRAC. And that will end up with the ATO, and we've seen a number of situations where it's that information, so that bank reporting information that gets passed on to the ATO, it triggers some inquiries. The ATO is not happy with the answers that they're getting from the taxpayer, and we end up with a tax assessment. So we need to be aware of that. It is very easy for the ATO to find out about fund transfers, particularly into Australia when we go above that $10,000 limit. But if we get into what is it within the tax system that we need to be conscious of, well, there's a few things. One, is there any indication that these funds could represent remuneration for employment services that have been performed or other business activities that have been undertaken? Now, in the case that we're looking at today, that was kind of one of the issues, that it looked like there had been some business dealings and there wasn't evidence to suggest that these taxpayers had already received full market remuneration for the work they'd performed. It left it open for the ATO and the AAT to say, well, at least some of this money may well represent remuneration for that work. We don't really know, but it opens that door. The second thing we want to be quite careful about is if it appears that any of the money has come from a company, a private company. Now, whether that is directly or indirectly, there are a few areas of the tax system that could potentially pick that up as assessable income. And the one to be particularly mindful of and watch out for is Division 7A. So whether it's a foreign company or an Australian company, it really doesn't matter. If we have a private company and basically money is coming out of that company and finding its way into the hands of a related party who is a shareholder or an associate of a shareholder, there's a pretty high likelihood we're going to have a Division 7A problem, a deemed unfranked dividend. There's some tricks in terms of what that taxable amount ends up being, but that's certainly something that can catch people out very, very easily. The third thing to be mindful of is where any of the money has come out of a trust. And again, where we need to be quite careful about is a foreign trust. For example, you might have clients who have family members overseas who are investing or running a business through a trust structure. They may be distributing current year profits to your client in Australia. Well, those are likely to be taxable in some way. Even if we're dealing with trust capital that's being distributed to Australian clients, If any of those distributions relate to income or profits that have been generated by the trust in previous years and have been accumulated inside that trust, those can be taxable when they're paid out as trust capital now to your clients. The section that we have to look at there in particular is Section 99B. And the thing to be aware of is when Section 99B is triggered, there is also an interest charge that can be imposed automatically on top of the actual tax liability, the main tax liability. So there's a couple of things there that we need to be careful about with our foreign trusts. And that would include what clients might think of as tax-free inheritances. Don't assume that what seems to be inheritance, if it's coming from overseas, I wouldn't assume that that's tax-free. We would normally start on the basis that there could be some tax to pay, and we've got to work our way through carefully to look at the components of that payment or that distribution, even if it's from a deceased estate. That does not necessarily make it tax-free. So quite a few things that can catch people out. Don't assume that something is a gift or a loan just because someone says it's a gift or a loan. We do need to investigate that a little bit further. As the numbers get larger, well, there's an expectation that we will do more work to try and figure out what these things really are. If we don't do it, the likelihood is that at some point the ATO will come along and have a closer look, and they will probably look on it a little bit less favourably.
And that's the roundup for this month. If your firm is not a member of Knowledge Shoppers yet and you'd love to see how we make a difference to practices across Australia, jump online or give the team a call. We'd love to show you what a difference we can make. Speak to you soon.